So this session here was on the board. It says it's income diversification, and we'll talk a little bit about income diversification. But I'm actually the presentation is more about financial troubleshooting for people who've been in farming for a while. So I'm happy to discuss any types of income diversification that you'd like. But I just want you to be to know up front that we're going to be talking more about just financial troubleshooting. So. My name is Paul Dittman. I work for a company called... Oh, thanks. So I work for a company called Compeer Financial. Compeer Financial is a farm credit system cooperative. The farm credit system has been around since 1916. We were originally set up by the federal government because farmers didn't have access to affordable credit. So the system is still pretty much the same. It's just a network of cooperatives all over the United States. I happen to work for the one that's that handles about half of Minnesota, the eastern half of Minnesota, about 2/3 of Wisconsin, the northern half of Illinois. My specific role at the company is I co-lead a loan program called the Emerging Markets Program. The Emerging Markets Program is specifically for people who are marketing their products directly to consumers or doing some sort of value-added production, processing, or marketing. So I work with a lot of folks who are selling vegetables direct to consumers, selling meat direct to consumers. I've got some meat processors in my portfolio, cheese plants, cideries. I mean, you name it. I've either seen it or I've got it in my portfolio right now. Indoor farming, all sorts of different stuff. So I've seen a lot of things that work. I've seen a lot of things that don't work. And we can talk about some of the things that I see that are pretty profitable and some things that I've seen that have not been profitable at all. Prior to coming to work for the Farm Credit System, for 5 years, I ran the Wisconsin Farm Center, which is the Farmers Assistance Program at the State Department of Agriculture in Wisconsin. So we were dealing with a lot of folks who were in pretty serious financial trouble, people who were having a lot of financial difficulties, including foreclosures, bankruptcies, people who were contemplating suicide, domestic violence situations, and we dealt with a lot of different things at the Farm Center. And before that, I was a county extension agent for a number of years. So I've been working with farmers on financial management issues for a really long time. I had an opportunity to work with Moses a number of years ago to write the book, Fearless Farm Finances. This green edition is the second edition of the book. The first edition came out, I think, in 2011. And then we taught a lot of workshops based on the content of the book. Based on the feedback that we were getting from people, we rewrote the book. So this is the latest edition that we've got in front of us here. So we're going to jump right into it. We're going to start by introducing our case study farm. It's Rosewater Farm. Rosewater is a CSA with 160 members. They also sell through farmers markets and some wholesale accounts. The farm's owners, Elliot and Sarah, feel like their checking account is always empty and their credit cards are always full. They pay themselves virtually nothing and are still barely treading water. And some days their farming dream seems like a nightmare. So do you know some people who might fall under this sort of situation? They need someone to take an objective look at their finances and help them figure out a viable path. And that's the thing. It seems like the folks that I've worked with over the years who've been in financial trouble, they're so close to it. It's difficult once you get into trouble to step back and take an objective look at your finances. And it really almost requires somebody to come in from the outside who doesn't have a vested interest in the farm, who doesn't have an emotional attachment to the farm. When people get under stress, they kind of get into tunnel vision, and it's hard to really see much or make decisions beyond just a really narrow scope. And so they tend to keep their heads down, keep farming, producing, and just ignore the financial parts of it. I mean, I've been to places where people were in foreclosure and they had been getting letters from the bank and never even opened them. That sort of thing. It's easier to ignore it. Every day that you're farming is a day that you haven't been taken off of your farm. So these folks are struggling. The first thing that we're going to do, if we're going to try to take an objective look at their finances, is we need to know where they stand. What financial resources do they have? And we do this with a balance sheet. So those of you who were in the workshop yesterday, you got a full dose of balance sheets. Sorry, you're going to get it again right now. So a balance sheet is simply a snapshot of the investment in the farm business. So that's all the assets. And then the financing methods that are used for those assets. And when I say financing methods, I don't just mean bank loans or credit card debt or those sorts of things. it's also the equity that you have tied up in your farm operation. Because you could theoretically sell the farm, sell all the assets, pay off your debts, and you could take your money and go invest it someplace else. So you're financing your farm assets, and that's going to show up on the balance sheet. Balance sheet just simply measures the farm's financial position at a given point in time. So we take a look at the balance sheet. On this day, we have this many assets, we have this many liabilities, and this is what our equity is. So the balance sheet, assets, that's everything that's owned by or payable to the business on the day that the balance sheet's put together. So it's farmland, it's machinery, it's the inventory that you have, it's prepaid expenses, all that stuff. Those are all assets. It's money that people owe you. So if you've got invoices out and they haven't been paid yet, that's actually considered an asset because it's something that's payable to your business. On the liability side, it's all the obligations that are owed by the business on the day the balance sheet's put together. So if you've got credit card debt, if you've got accounts payable, if you've got longer term loans, all that stuff, those are all liabilities. We take the assets minus liabilities, and that gives us the owner's equity or the net worth. And so that's your piece of the pie. So that's your ownership piece of the farm. So what's so great about a balance sheet? Well, it documents the value of all the farm assets and outstanding liabilities at a given point in time. So if we can do this balance sheet, and I always recommend doing it on December 31 or January 1, if you're in financial trouble, doing it more often. But if we can at least force ourselves to do this and constantly update that balance sheet on the same day every year, we'll have a record that we can go back and look, and we can see how things have progressed in the business over time or have maybe gone backwards. It allows us to calculate a couple of important measures that fall in the categories of liquidity and solvency. Liquidity is all short-term. It's current assets and current liabilities. It's cash, anything that's going to convert to cash, anything that's going to be used up on the farm within a year, versus any of the current liabilities. So that's anything that's due now or that's going to come due within a year. So liquidity is particularly important, especially if you're in financial trouble. Solvency looks at the entire balance sheet, so all of the assets and all of the liabilities, and it tells you if you sold all of your assets, you paid off all the liabilities, are you going to walk away with something or not? If you will, you're solvent. If you won't, you're insolvent. It'll show progress that you're making in the farm business even if the cash flow seems tight. So there's going to be times when it feels like you're just spinning your wheels. You start the year, you got $1,000 in the farm checking account. The end of the year, we got $1,000 in the checking account. You worked hard all year long. There was a lot of money that came in. There was a lot of money that went out, but not much of it stuck around. If you're doing your balance sheet, though, every year, you can look back at last year's balance sheet and look at this year's balance sheet, and you may see that you've built up inventory. If you're in the beef business, last year you had 10 cows. This year you got 20 cows. So you might not have any more in the checking account, but you've built equity. You've got more on your balance sheet than you had the previous year. Finally, if you can do that balance sheet on December 31, January 1 every year, it's going to end up lining up with your taxes. It lines up with the tax year. And so then you can put it together with your Schedule F or Schedule C if you're operating a value-added type of a business. And you can do a full-blown financial analysis of your farm operation. So again, the key information that we're taking from the balance sheet, liquidity and solvency. Liquidity is just the ability of the farm to meet its current liabilities with current assets. So you've got these bills that are due, you've got credit card debt that theoretically is due right now. Do you have enough current assets to cover all of the current liabilities if you had to? Solvency is looking at the entire balance sheet, the ability of the farm to pay off all of its debts with all of the farm assets. So this balance sheet is for our example farm. I don't know if we had a handout for this. Say, Eli, do you know if we had a handout for this session? I thought it sent. Right? Did everybody get it? Okay. Yeah, I usually try to make a handout for anything where the numbers are going to be really small on the screen so you've got it in front of you, you can see it. So these folks, we're going to start with the current asset side here. So cash and equivalents, they've got $2,000. So that might be $2,000 in their checking account. They've got some accounts receivable here, about $3,000. So they've got invoices out that haven't been paid yet. They've got some crop inventory here, $1,000 worth. They've got growing crops here of $5,000. And then they've got some prepaid expenses, about $2,000. So they've got $14,000 of current assets. So again, current assets that's anything that's cash. anything that's going to convert to cash, or anything that's going to be used up on the farm within a year. So that's why all those things fall in that category of current assets. So they're not sitting on a lot of cash, only $2,000, but they do have some other current assets. And these are things that they're going to be collecting those bills, or they're going to be selling off that inventory and turning it into cash. Now, in the current asset side, the assets are typically listed in their order of liquidity. So if you have a bill that comes due, going to your checking account, taking cash out of your savings are going to be the number one way to get liquidity to pay those bills, right? Next might be accounts receivable. Somebody owes you money, you get on the phone and you call them and say, hey, I really need that money today because I've got a bill that's coming due. And then it goes down to crop inventory. So maybe you've got crop inventory that you didn't really want to sell right now, but you do intend to sell it at some point. You can sell it and free up some cash. So you go down the list and you can see how it becomes less liquid as you go down. They've got some intermediate farm assets. Now, intermediate farm assets, those are assets that have a life of at least a year and less than about 10 years. Businesses outside of agriculture typically don't have a category for intermediate assets. They typically just have current and non-current assets, current, non-current liabilities. We like to have this category of intermediate assets because we've got a couple of things that fall in there: equipment and breeding livestock. Those are two big things. Farm vehicles also fall in there. Stock and co-ops can fall in there. There's some other categories or other types of assets that fall under that category of intermediate farm assets, but it's things that have a life of at least a year, less than 10 years or so. So they've got some machinery and equipment. They've got $100,000 worth, and then they've got some farm vehicles. That's $30,000. So they've got $130,000 of intermediate farm assets. And then they've got a long-term farm asset, which is their farm, and that's worth $400,000. So we total that whole column up. We've got $544,000 of total assets on the farm. So that's pretty good. On the farm liability side, they've got some accounts payable. That's $15,000 of accounts payable. I'm going to show another schedule here in a minute where we're going to dig in a little bit deeper to this, to each one of these categories. So $15,000 of accounts payable. So that's supposed to be paid right now. I mean, those are bills that are due. They've got an operating loan, and that's $10,000. Operating loans are supposed to be paid to zero each year. They're supposed to be used for operating purposes and paid back with operating income. So that's a current liability. That's all due right now. They've got principal due within a year on longer-term debt, and so that's probably on machinery note. Yes?
I have a question I guess I should have asked yesterday, but an operating loan, where does that come from? Or I don't know what an operating loan is, I guess.
Okay.
I can deduce it's for operating, but
Yeah.
tell me how that should be.
Okay. So the question is about operating loans. So where does an operating loan come from? We write a lot of operating loans as a company. And an operating loan is just for operating purposes. So you figure out how much you're going to need to buy your inputs, to buy market livestock that you're going to finish out, all those sorts of things. You get an operating loan, and it's a revolving line of credit. So it's, you can tie it to your checking account. You can transfer funds in and out of it, make payments on the operating loan. So it's just a revolving line of credit, basically, with an upper limit.
If it's meant to be paid off each year, it's more like you manage your cash flow than anything else?
Right.
It's not like a big, huge loan that you're paying out over years and years.
Yeah, exactly.
It's at the beginning of the season.
Right. Yeah, it's an operating loan. It's just it doesn't have amortized payments. It's just you've got a certain dollar amount that's your limit, and you can use it as you need it, and you pay it back as you can. You only get charged interest while the operating loan is in, or while you have a principal balance on the operating loan. Yeah, but you shouldn't be putting machinery on it. You don't buy land with an operating loan. It's just for your operating purposes. It's supposed to be. It doesn't always work that way. Yes.
Just as an example, I talked about an operating loan this past spring, because last year we hit a huge brick wall, so we knew that we were going to have expenses regarding paying our employees in the springtime. We also had some seed costs and some soil costs, so we took out an operating loan.
And that's before you had money coming in.
Yeah, and before we had any money coming in, but we knew we were going to have money coming in based on prior years, so that was, we set that up for us.
Yeah, and the comment was, and I'm repeating because we're recording, but, so the comment was that you had a situation where you knew you were going to be short of cash, so you took an operating loan to pay employees, pay for some inputs and things, but you knew that you'd have the cash coming in later in the year to pay it back. Yeah, and that's really how an operating loan is supposed to work. Yeah.
How small do you go on buying small equipment, tools that are gonna last 10 years, that they're, one at a time, they're not that big, but should I continuously be adding those and circular saws and small things that are lasting for that, or is that?
Yeah, so the question is about how small can the assets be in the intermediate asset category? Because if you're a vegetable farmer, you're buying hoes and shovels, and you might be buying some other small tools and stuff, of which individually are $100, $10, $20. What we typically do is it's kind of flexible. It is sort of up to the individual client in my estimation. And some will say they'll lump all the small tools are $5,000, and they don't list anything individually there. And then they only list things that are worth more than $1,000 or more than $5,000. Kind of depends on the farm. I work with a lot of Amish farmers, and they'll have an equipment list that's 2 pages long, and there isn't a single piece of equipment on there that's worth more than $500. But they like to have it all listed out, and that's great. It's as much detail as you want to put into it. Yeah, and the more the better. But yeah, you can't really, if you got 300 individual items that none of which are worth more than $50, yeah, you don't want to go through and do an inventory on all that stuff. Yeah. Let's see. I wanted to go back to the operating loan again. A lot of times what we're doing, the farmers that I work with, a lot of them are startup operations. They started farming out of pocket. They're paying cash for stuff, and then they're putting some stuff on credit cards and paying it down right away. And then they buy something a little bit bigger, and they put it on a credit card, and they aren't able to pay it down right away. And then pretty soon it sort of snowballs, and now all of a sudden you've got $20,000 of credit card debt that's accruing 18 to 25% interest. If it's a business card, it can be in the 20% plus range on interest. And so that's usually when they come to us, and we'll make an operating loan that then they'll use to pay off their credit cards, because the operating loan will be, like right now under our emerging markets program, our operating loans are around 3.75%. So they can pay off 18 or 20% interest using a 3.75% interest rate on our loan, and then they can pay ours down a lot faster. I was working with someone this past week. She's got about $35,000 of credit card debt. She's been making $900 a month payments on the credit card debt to try to chunk it down. But when you do the math, that $900 a month payment, $550 of it is going to interest. So she's making almost no progress trying to pay down this credit card, and has this thing hanging over her head and hitting her cash flow like crazy. And so that's really a good use of an operating loan. Yeah. So talk to a local lender. Talk to me. I'd be happy to talk to you about it. But yeah, it's important to establish that operating line of credit to run your business, because you don't want to run it with credit cards. Yeah.
Maybe the way your operating loans are set up is you don't make any payments at the end of the year, and then you get interest on the unpaid principal, and then if you don't, they're going to be set up over 3 years, right?
Yeah. So the
3 years, and the interest you pay at the end of the year, there's no payment during the year. Hopefully at the end of the year, you can pay out the interest and the principal.
Right. Yeah. So the comment was about how we set up an operating loan, and it varies. So usually the first time I write an operating loan with somebody, I just do it on a 1-year renewable, and see how it performs. Because if sometimes someone will take an operating loan and they'll max it out right away. They're paying off their credit card, so they've got $20,000 of credit card debt. They take a $20,000 operating loan, max it out, pay off the credit card, with the intention of paying down the operating loan over the year, or at least paying it off at the end of the year. We get to the end of the year and it's still at $20,000. And so then I may renew it at that point. We do have to collect the interest at least once a year. So I can collect the interest and renew it if there's a good reason for not paying it down. If not, then a lot of times I'll end up what we call terming it out. So we'll put it on a 5-year note with a regular principal and interest payment. The interest rate is still pretty reasonable. It's around 4%, but yeah, we like to see it revolve. If it performs well the first year, then I'll write it on a 3-year renewable basis. So then the interest just has to be paid each year. But we want to see it. We want to see it go up and down and up and down. It should, or go down and just never touch it. That's fine too. But yeah, we want to see it revolve though. Yeah. Okay, so the other thing that falls under current farm liabilities, you see here, they've got principal due in less than a year on term debt. And so they've got down here, it looks like maybe an equipment loan of some sort, and then they've got a mortgage on the farm down here too. Any of the principal on those longer term loans that's going to come due within the next year shows up as a current liability because it's due within a year. So current liabilities, anything due now or anything that's going to come due within a year. So that principal ends up here as a current farm liability. So we total that all up. Their total current farm liabilities are $50,041. Current farm assets, they've only got $14,000. So they don't have near enough current farm assets to pay off all their current farm liabilities. We have a couple ratios that we calculate, but the one thing that we look at most closely is working capital. So we're looking at the dollar amount there. So that's just current assets minus the current liabilities equals the working capital. They got $14,000 of current assets. They've got $50,041 of current liabilities. So they've got negative $36,041 of working capital. So that's, from my standpoint, that's a major red flag. That's a really serious issue because if they get hit with some big unexpected expense or they have a total crop failure or something, they're really in a world of hurt. They just have nothing to fall back on. We want this number here to be at least 15% of the annual gross farm income. So we're going to have to take a look at their Schedule F, which we will here in a minute, but we want that to be 15% of annual gross farm income. So we know there's going to be a pretty serious deficit. The deficit isn't just $36,000. It's going to be quite a bit more than that. And so we're going to have to come up with a plan to rebuild that. The other thing we like to see is at least 2 times as many current assets as current liabilities. And obviously they don't have that either. If we look at their overall solvency, we're looking at the total equity, and their equity position is right down here, 121,477. We're just taking the total assets minus the total liabilities to give us the equity. We're taking that $121,000 of equity and dividing it by the $544,000 of assets that they have. Their equity position is about 22%. So that's relatively low. Our rule of thumb is we want that equity position to be equal to a person's age. So if these folks are 30 years old, we'd like to see them have about a 30% equity position.
Why is that?
It's just kind of it's just a rule of thumb that we use with beginning farmers. Once we go beyond beginning farmers, past 10 years of experience, then it becomes 50%. We want to see at least 50% equity. But when we're underwriting a loan, you know, we're looking at a lot of different factors, and so let's say these folks are at 22% equity, but their credit score is good. They've got the cash flow is decent or whatever. We look at a lot of different factors when we make a loan decision, so it's not like a hard and fast rule, but that's just one of the benchmarks that we look at. Yeah.
So I have my farm in an LLC. So I'm assuming there's separate balance sheets for each one, and most of the large assets on my personal one. So if you were a lender, would you look at my personal or have the farm LLC secured by personal assets? Like how would you, if the farm doesn't have any most of those large assets in the LLC?
Yeah, so the question is about, so what if you've got an LLC, but most of the big assets are yours personally. So you own your farmland personally, and you lease it to your LLC. So how do we make a loan to the LLC if it doesn't really have much on its balance sheet? And we do tie both together. Yeah, we would ask, we could make the LLC the primary borrower, but we would ask you to sign personally. We'd gather your personal balance sheet too. We'd combine the two when we do the underwriting. Now with FSA, the operating entity has to be involved in the loan. So like you wouldn't be able to borrow personally to buy a farm without the LLC's involvement because the LLC is the operating entity that has the risk in the growing crop and that sort of thing. Yeah. Any other questions before we move beyond this one? Okay. So we're going to dig in a little bit deeper into the liability section of the balance sheet because these folks are in trouble. So we really want to try to understand what's going on. And this is a schedule so that the balance sheet, let me back up for just a second here. So this balance sheet, you can see it references schedules. So Schedule 1, Schedule 2, 4, 17, 18. So this is a summary page for the balance sheet. There's a bunch of schedules behind it that go into a lot more detail. So there'll be a schedule that's got the list of all the machinery. There's another schedule that's got the list of the farm vehicles. There's a schedule for breeding stock. So there's a bunch of different supporting schedules that all roll up to this front balance sheet. And so we're going to look at the schedules that pertain to all the debt. And so the first schedule is for accounts payable, taxes due if there were property taxes due or income taxes or FICA or whatever that was due. That would all get listed in this schedule. Remember, we had $15,000 of accounts payable. We didn't see any detail on it. Now we go to the schedule. It's all credit card debt. It's $15,000 of credit card debt. And so that, to me, as a lender, that's a significant red flag right there. Because you've got that much credit card debt, that's a real problem when it's accruing at 18+% interest. Down here, Schedule 20, this is where we're listing any operating loans that are standing out there. And so they've got an operating loan with us. And the maximum balance on the operating loan is $10,000. The current balance is $10,000. So they've maxed it out. They've gone right to the limit on the operating loan. So that's a bit of a red flag to me. As we dig in a little bit deeper, we saw that there were some intermediate liabilities. There was just a total amount of intermediate liabilities. But we go into the detail here, and you can see they've got 3 separate intermediate loans. The challenge with an intermediate loan when it comes to working capital is that they're on a really short term. They might be a 3-year term, they might be a 4 or 5-year term, up to a 7-year term. So when you're trying to pay for something in that short a period of time, there's a lot of principal that's due each year, which is a good thing on the one hand because you're building equity fast. But on the other hand, it's also a lot of principal that's coming due in 1 year that hits your working capital. So they've got 3 separate loans here. And this is an area that I look at pretty closely because this is where you start seeing, is this person, are they buying toys versus buying things they really need for the farm? I got a balance sheet from someone earlier this year. I had to add a bunch of lines in this schedule. The guy had 17 intermediate term loans and anywhere from 0% up to like 13% interest rates. And this was a small farm. It was a 40-acre farm, and the guy owned 2 combines, one of which he still had a loan on. And it was, I was thinking about doing custom work, but I haven't really gotten a lot of business there. And then he started a custom haying business, so he's got a bunch of haying equipment. And that hasn't quite gone the way that he'd hoped it would. And he's going to quit his off-farm job to farm full-time. And I'm like, no, absolutely not. Don't do that. Sell the combine. Sell both combines. Sell all your haying equipment. Get rid of all this intermediate term debt. But he had a couple of side-by-sides. He had a snowmobile. And debt on all of it. It was crazy. And he got mad at me when I said, that's ridiculous. 17 intermediate term loans. Get rid of all of that stuff. So he's not a client, but and his sister works for our company too, by the way. So anyway, I digress. So lots of principal due within 1 year. So if I'm looking at this, and if it doesn't look like it's a bunch of toys that I don't want to write a new loan on, I'm going to probably look at maybe lumping that together, and maybe we put it on a new note that's a 7-year note to try to ease the cash flow. Then you don't have quite as much principal due within 1 year, and the loan payments are going to be a little bit less. So I'm going to look at probably doing something like that with this farm. They've got 2 mortgages. One's with FSA, so they're looks like they must have gotten their farm with a 540-550, the beginning farmer down payment program. So there was really good rates on that loan. And then when we're doing the 540-550 program, we usually get a guarantee on our loan, and then we write the interest rate down by 0.5%. So the interest rates on their longer term debt are actually pretty good. There's probably not going to be a lot of room to make any adjustments there, other than if we were going to stretch the terms out on our loan or something. But really the problems are further up here. It's the the credit card debt, it's maxing out the operating loan, and then it's this intermediate term debt that's really the problem. Yeah.
Do you have templates for the balance sheet schedules?
Yeah, I'm happy to share this balance sheet with you. It's a little different than the one that we looked at yesterday. The one we looked at yesterday was a super simple balance sheet. This one's not complicated. It's actually, this is the balance sheet I use with most of my clients.
Yeah, having a schedule to use it to then plug into the balance sheet looks like it'd be really helpful.
Yeah, it's great. And then it flows to that summary, you know. Someone yesterday asked me about how do you calculate the principal due within 1 year on longer term debt. That's the nice thing about this balance sheet. I was looking all over. I couldn't find a balance sheet that calculated that. It's not a difficult calculation, but we always had to do it by hand. This balance sheet actually calculates that and puts that number up front. So it's great. So yeah, just my email address is in all the course materials. Just send me an email. I'm happy to send you this balance sheet. This actually came from Ohio State University, so this is publicly available anyway. Okay, so that was the balance sheet. We looked at their balance sheet. We kind of identified where there's some significant issues there that we're going to need to figure out how to clear up. Next, we want to take a look at their 2020 Schedule F. So Schedule F, profit or loss from farming. If you're farming, you're filing a Schedule F every year. And so this is what their Schedule F looks like. They had, I'm having trouble reading my own numbers, but I think that's $133,300 of gross farm income. They had a bunch of expenses. They had some depreciation, so of course, which is not a cash expense. But we get down to the bottom line. It shows a net farm profit of $21,600. So they're saying $21,600, but our working capital is really bad, and it feels like our cash flow is terrible. And so how do we square this? So Schedule F shows $21,600. They're struggling to make ends meet. Balance sheet's a mess. So what's the deal here? Well, if we think about Schedule F, Schedule F is usually based on cash accounting. So it records things as cash comes in or as cash gets paid out. Doesn't necessarily, it's different than non-farm businesses that use accrual accounting. So accrual accounting, if you send product out and you send an invoice out with that product, that's when it shows up as a sale. With cash accounting, it's when you receive a check for that product that you sent out that it shows up as a sale. You know, so there can be some timing issues. That can be a good thing. I mean, you could use it to your advantage by shoving income into the previous year or pulling it forward or pushing it into the next year to manage your tax situation. Same thing with bills and things like that. But you have to take that into consideration when we're looking at the Schedule F. One big exception to that is depreciation, and that's a non-cash expense that can vary a lot from year to year. You know, farmers have some advantages with depreciation that other businesses don't. You've got Section 179 where you can completely expense a capital purchase in the first year. You know, so you buy a new tractor, it costs you $15,000. You use Section 179, put $15,000 of depreciation on your Schedule F, and you'll show no income, right? We also have bonus depreciation. So there's things that you can do with depreciation to make your bottom line look really bad, but it sort of distorts the performance of your farm as far as Schedule F goes. Schedule F only pertains to the farm business, so it's not going to include anything on the personal side. If you got student loan payments, yeah.
Okay, back to depreciation. So how do you determine if someone wants to get his taxable income down to like $10,000 so he should buy a $50,000 tractor and take the depreciation? Is there kind of a rule of thumb or is it just a magic?
Yeah. So the question is about depreciation, and if you want to try to manage your income tax liability down to a certain level, so do you go out and buy a piece of equipment and then fully depreciate it to try to drive that down? That's really more of a question for your tax preparer. And most of
Look at someone that's going to get a loan and you depreciate something off to offset your personal income to get your taxable income down. So do you have some guidelines that you use?
Oh, so you're asking more from the lending side. Right. What do we look at? Because we'll look at your Schedule F and it looks like, oh, they lost money every single year. I can't make a loan to that person. Well, what we do is we just add back the depreciation because we know that the tax depreciation or depreciation on the Schedule F tends to be kind of a phony number, you know, because you can play with it so much. So it isn't giving us a real picture of the farm's performance if you're just, you know, for tax purposes writing it all off. and showing a loss. So we add that depreciation back, but then we replace it with economic depreciation. And we talked about that yesterday, where we'll say equipment, we'll take an economic depreciation charge of 15% of the value each year. Taking it a step farther, we get to cash flow, then we'll say, well, if you're making principal payments on intermediate term debt, so on equipment debt, you're replacing that capital equipment each year. You're taking loans to buy new equipment, so you're obviously replacing your equipment, and will reduce that economic depreciation by that amount. So when it comes to cash flow, the depreciation, we tend to take it completely out of the equation and then bring in something else and play around with it. We want to make sure that there's enough cash flow in the operation. We're not too concerned about the tax depreciation piece of it, I guess, is the bottom line. Yeah. Schedule F only pertains to the farm business, so it's not going to include anything on your family side. If you've got big student loan payments or you've got a personal vehicle, things like that, they're not going to show up on Schedule F. All of your family living expenses, none of that's going to show up on Schedule F. It doesn't capture changes in inventory or in payables or receivables or the value of home-raised breeding livestock and things like that, all of which affect your profitability. Because you may be building inventory. If you're just getting started, you're starting a beef cow herd, for example. So you're buying cows, you're buying fencing, you've got vet expenses, you may be buying feed, and so you've got all these expenses. All those expenses are going to show up on Schedule F, but you're building your herd, and so you're adding animals. You've got calves. You're increasing the value of your cows as they get bigger and that sort of thing. None of that is showing up on Schedule F, right? Because you're not selling anything, there's no cash income from it. Doesn't mean that it was a bad investment, but it's not going to show up on Schedule F. Doesn't include principal payments on loans either. It includes interest on loans, but it doesn't include the principal payments on loans. So that's something that's going to hit your cash flow that isn't going to show up on Schedule F. So that's why there'll be a discrepancy between what shows up on Schedule F and what your actual cash flow is. So we really need to dig into Rosewater Farms' cash flow to get a little better handle on what's happening here. And I think you've got this in your handout as well. So they're starting the year, they've got $2,000 in the farm checking account. They sold some eggs in the month of January. They have some off-farm income in January, $2,400. So the total cash in was $2,750, just these two numbers. They started with $2,000, they put this much into the checking account. And then they had to pay some feed bills, they had fuel and oil, they had an insurance bill that came due, they have some repairs, supplies, first half of their property taxes they had to pay, they've got utilities on down the line. Then they had to make their loan payments, so all their loan payments show up on this line right here. And then they took something out to live on. They took $2,500 out for family living. So they brought in $2,750, they started with $2,000, and then they paid out a total of $10,436. So they ended the month with a negative balance of $5,686. So what happened there? Well, typically what would happen with a farm family, they're sitting down, they're paying all these bills, and at some point there's no more money left, right? So they're either putting stuff on credit cards in here so that they can continue paying the bills. A lot of times they're cutting the family living costs to next to nothing, but they've got better than a $5,000 deficit that month, so they can cut their family living to zero. Still not going to make up that deficit. So they're going to run a negative balance. They might be letting some bills slide, and if they let bills slide, then their credit is going to start to get hit. So I mean, it starts some bad things happening. The next month, they start bringing in some income from CSA subscriptions, so that's a pretty significant amount of money, $32,000 there. Still selling some eggs, still working a little bit off farm, paying a bunch of bills, making their mortgage payments, taking something out for family living, and now they've got $16,628 at the end of the month, and that begins the next month. And so we're watching, what we're doing here is we're going to watch this bottom line number all the way through the year and see if it ever goes negative. Anytime it goes negative is a red flag. That's where we need to come up with a better plan. And so it could be taking an operating loan. I mean, if they're anticipating this, if they're running a cash flow ahead, here we're looking back at the previous year's cash flow. But if they were doing this in December of 2021, putting together a cash flow for 2022, they could anticipate, we're going to be short by $5,000 in this month, and we're going to be short by 2,000 this month and 4,000 or 6,000 this month and 10,000 at the end of the year, and trying to take an operating loan, or whatever. I mean, there's a lot of things that you could do. Change up your product mix, bring in more off-farm income. And there's a lot of stuff that you can do if you can anticipate this ahead. But for these folks, we're looking back. We're looking back at 2020. So what did the cash flow look like? Well, they ended the year with a negative balance of $10,000 after we're working hard all year, making all their payments, paying all their bills, not taking a whole lot out for family living. That's not very much for family living. So that's what the cash flow looks like. So now we know what the starting point is. So we've seen their balance sheet. We kind of know what the problems are in the balance sheet. We realize there's a pretty significant cash flow issue if they're ending the year with that big of a deficit. But now we have to dig in a little bit deeper and figure out where is the problem in the operation that needs to be adjusted. So this is their CSA budget. So we're doing an enterprise budget here. And an enterprise budget is basically just looking at what's all the revenue that we're bringing in this enterprise, and then what are all the variable costs associated with the enterprise. So these are costs that you wouldn't have if you weren't producing anything. Things like seed, fertilizer, soil amendments, hired help, that sort of stuff. If you weren't producing anything in your CSA, you wouldn't have any of these expenses. Down here, these are overhead expenses. So these are expenses you're going to have whether or not you've got anything being produced on the farm at all or not. So we're going to charge this enterprise something for the use of our land. We're going to have repairs and insurance on the buildings and equipment that maybe can't be allocated directly to one enterprise or another. So we're just going to put it in as an overhead charge that we're going to charge to the CSA enterprise. And then other overhead costs, and that could be a whole bunch of different stuff that fall into the other overhead costs. Depreciation and things like that would fall in there. So they're bringing in $96,000 a year from their CSA. They're paying out $67,800 in all these variable costs, and then they're paying out another $24,000 in overhead costs, $24,000 in overhead costs, excuse me. So their net return from CSA is about $4,200 a year. And then they're also selling at farmers markets. This is their farmers market budget. They're bringing in $27,200 at farmers market. They've got $8,900 of variable costs associated with the farmers market part of their operation. They're using less land, so they're not charging as much of a land charge there, or for repairs, or for overhead costs. So total cost there, overhead costs $11,250. So the net return from farmers market is $7,050. So they're going to look at this and say, well, geez, we're making more from farmers market than we are from CSA. So should we drop CSA and just go with farmers markets? Well, we want to dig in a little bit deeper again. So 4,200 versus 7,050. At first blush, it kind of looks like farmers market is better. But we've got 4 different farmers markets that they're going to. And they've got 2 markets that do really well, and there's 2 markets that don't do very well. So they're breaking their enterprise budget down further and looking at the 2 really good markets, trying to figure out what's the net return from those versus the poor markets. So at $600 a week gross income from these markets, they're bringing in $19,200 at these 2 markets. All the variable costs and overhead costs are basically the same. Doesn't matter which markets they're going to. They just took all those costs and split them in 2. And so the net return is $91.25 from the 2 good markets. And at the 2 poorer markets, they're bringing in $8,000 a year. They're only grossing $250 a week. They still have all the variable costs and all the overhead costs they did with the other market, and they're losing $2,075. So should they still go to that market? The rule of thumb is, with enterprise budgeting, on a 1-year basis, if you can at least cover your overhead costs with your gross revenue, it makes sense to be there. Over the long run, if you can't cover all of your costs by being there, you shouldn't be there. So if you're looking out year after year after year, and every year you're showing this kind of a loss by going to these markets, you shouldn't be going to those markets. It doesn't make sense to do it. But in the short run, if you can at least cover this and you make some contribution to your overhead, it still kind of makes sense to do it. They know that they're in trouble though, so they're probably going to have to drop these markets. Yeah.
So I understand why it's helpful by like percentage of land area when you kind of calculate that out? That's the thing I struggle with. It's like, well, the same fields are contributing to the CSA and the farmer's market and the, restaurant. How do you decide what inputs are going to which enterprise?
Yeah, so the question is, so you've got multiple enterprises, and all the product that goes to either one of those enterprises coming out of the same fields. It isn't like, well, I've got this field just for CSA, all my CSA vegetables are growing here, and then these fields over here are just for farmer's market. It's all commingled, so how do you figure it out? It's, there's not really a good formula for it. It's kind of your gut feeling. Like, it seems like I'm using 3/4 of my acreage for the CSA, and 3/4 of my production is going to my CSA subscribers, and 1/4 of my production is going to farmers market, even though it's all coming out of the same fields. And then you're just trying to allocate those to the enterprises in a way that's reasonable and fair. Yeah.
Well, I was gonna say, I don't really have an answer, but what I do is I document where my harvests are going to. So how much did I harvest and what's it going to, and then I document, is it going to the CSA, and then I will look at later and see, like out of those harvests, and then determine from there how much land I use for, like just feeds for my CSA versus feeds for my farmers.
Yeah, so the comment was I track all the produce that comes out of the field, I monitor it, I document it, and then I say this much went to CSA, this much went to farmers market, this much went to wholesale, and track it that way.
I mean, that's not 100% accurate either, you know what I mean, for example, what I use, but.
Yeah. Okay. Yeah, and with enterprise budgets, you can drill down as deep as you want. It's some people like to have, let's say they're doing CSA and they've got maybe 5 or 10 main vegetable crops that come out of their CSA, and then they fill in with a lot of other stuff. They may do enterprise budgets for each one of those 5 to 10 major crops. It's a little bit more difficult with CSA because it isn't like a farmer's market where you can say, okay, I went to farmer's market and I know that I sold 50 pounds of potatoes this week. It's whatever you produce is going in the box and it's going somewhere, right? So it's hard to say, well, this made up so much of my revenue, but you can drill down as much as you want. Okay, so now that we've kind of gotten a picture of what's going on here, we're going to make a few changes. So we're going to start by rebalancing the balance sheet a bit. And so what I did here was I took the credit card debt and I left the operating loan alone just because I didn't really have room to move it someplace. So I just took that credit card debt and I took those 3 loans that we had here under intermediate term debt and I rolled it into a new note. So I combined it all together and now there's a new note there, is that $64,000 with an annual payment of $10,660. So we just took all that. What I did with our loan, I don't remember what the interest rate was before, but we have, at Compeer, we can do something called a loan conversion. So if interest rates drop, as long as you've had your loan in place for a year, if interest rates have dropped over that year, for just like a $300 conversion fee, I can convert to a new loan amount, or to a new loan interest rate, I should say. And so we do a calculation, and usually the rule of thumb is if you could pay that $300 fee in less than 3 months with the interest savings, it makes sense to do a conversion. And so in this case, we were able to do the conversion, so we dropped the interest rate down to 4 1/4. So that eased a little bit of the cash flow there too. The loan payments ended up going down a bit. And so what did that do? Made the working capital better, quite a bit better than what it was, but it's still not quite good enough. We still have current liabilities of $29,000, significantly less than what we had before, but still not quite where we want it to be. But it helped. Hopefully, if we can improve the cash flow a bit, make it easier to pay that operating loan back, that improves the working capital a bit more. So that's one thing that we took a look at. So the cash flow is a little bit better. Now we're ending the year with a deficit of $4,000 instead of $10,000. So that's good. Still not good enough though, so we're going to make another change. We're going to drop the 2 poorest farmers markets. So we don't want to waste our time going to those 2 markets. We're going to cut all those operating expenses, and we're going to boost our other sales by $8,000. So maybe we're going to sell more on the wholesale market. We're going to try to sell more at the 2 good markets that we go to. So we make those market adjustments. We add a little bit more income up here, and we still made all those other balance sheet changes already. So now cash flow, the balance is negative by $2,700 at the end of the year. So it's gotten a lot better. It went from 10,000 deficit to 275 deficit. So we're still a little bit short, but to me, that's within striking distance. You know, if we can make some cuts someplace in here, and usually what we're looking for, if we're going to start looking at cutting expenses, you know, and we didn't really look at any of the operating expenses at this point. But when we start looking at the operating expenses, we're going to look at the biggest categories first, because if you make a small change in a really big expense category, it's going to have a much bigger impact on the bottom line than making big changes in small categories. So the biggest category by far is hired labor, right? I mean, there's a lot of hired labor costs in there. $51,000 that's going out to hired labor. The 2 owners are only taking $30,000 out of the business. They're paying $51,000 out to other people, but only taking $30,000 themselves. Does that sound familiar? It happens a lot, unfortunately. So if we can, you know, we don't have a very big deficit to make up here, you know, at $2,000. So can we save $2,000 in hired labor costs in some way or another? Or if it means bringing in a little bit more off-farm income, or maybe it's changing up our enterprises, adding a few more hens or something, and bringing in more egg money. I mean, we're within striking distance when we get down to that $2,000. It's not a huge deal at that point. So what other steps could they take? Well, keep cutting hired labor costs. You know, by far biggest operating expenses. And working with smaller scale vegetable growers, labor cost is always the biggest cost. It's always a huge cost if you have hired labor. Adding other product offerings, trying to increase your sales per customer. You've got these customers, they like you, they trust you, they want to buy stuff from you, so give them more stuff that they can buy from you. Might be adding another livestock enterprise. Maybe you're adding things like honey or maple syrup. Maybe you start partnering with other farms in the neighborhood to sell their products to your customers. If you don't raise beef, but you've got a neighbor who raises grass-fed beef, you start marketing their beef for them and taking a margin for doing it. So I think we've gotten pretty close on this one. I think there's some good options for them. Drop CSA and concentrate on growing and marketing the most profitable crops. You know, that probably sounds like heresy, but I actually have a customer in my portfolio. She came to me for a loan about 5 or 6 years ago. Pretty sizable operation, pretty sizable CSA operation, also sold at several farmers markets, did winter markets, sold to restaurant accounts, and I couldn't make a loan to her. The cash flow, her balance sheet wasn't quite where it needed to be, the cash flow wasn't where it needed to be. She came back 2 years later. She had dropped her CSA. She went in, looked at her numbers. She said, you know, I had so much hired labor costs with CSA. There were a number of crops that we had trouble growing. We had some crops that we did really well with. We had other crops we didn't. But we had to offer this mix of vegetables and CSA. She dropped her CSA. She concentrated on her most profitable other customers, so whether they're farmers markets or restaurants. Her gross income went down a lot, obviously. She got rid of a significant portion of her revenue. But her bottom line went up so much, I was able to make a loan to her. So, I mean, her situation had changed that much. And it's gotten better over the years. We've done loan conversions to bring her interest rates down. I mean, she's actually done really, really well. But it was cutting CSA was the key for her. You know, she just felt like the amount of hired labor that we had, and it was becoming more difficult to get hired labor. And so for her, that was the answer. I'm not saying that that's a magic answer for everybody, but for her, that was the answer. Yeah, Joe?
Is the solution to charge more for the CSA and produce the labor? Is what charge enough for?
Yeah, so is the solution to charge more for CSA? On the one hand, it sounds like that would be the answer. But when, you know, I'm in the Madison area, and this person happens to be in the Madison area, there's so many CSA operations in the Madison area that you can't really price yourself out. You have to pretty much be in line with what everybody else is charging. And CSA is tough. I mean, I know some of you in here are running CSAs. It's, you have some attrition every year anyway because people feel guilty about throwing vegetables away and stuff like that. So you're constantly trying to rebuild your numbers of people, or subscribers, I should say. So it's tough to just say, well, I can't make it at $600 for a full subscription. I'm going to charge $700, because then you're pushing them to 5 other CSAs that are still charging $600. Yeah, there's some loyalty, but maybe not quite that much. Yeah.
Question probably is a whole half-day conference, but keep cutting higher labor costs. Like, is there like about 2 examples of that?
Yeah, so keep cutting higher labor costs. How do you do that?
If you feel like you hire more people as it is, but we know that maybe, I mean, it's a huge expense.
Yeah.
So, and then work-life balance, like I'd like to not be impacted at paid all the time.
Yeah. Yeah, hired labor it's always tough, and it's just gotten tougher and tougher, especially recently, Yeah, you can pay people, but they're never going to work as hard as you do. It's not their farm. They don't, as much as they're dedicated to it, they won't be as dedicated as you are. And you're always going to end up with clunkers who just, for whatever reason, can't figure out how to do what you need them to do. So, yeah, it's, I don't know that there's a good answer for how you do it. Maybe people here have some ideas. Yes? Volunteers.
Yeah, we've been responding more to those emails. Last year, we had a few people like, oh, I'd like to volunteer in your farm. We would be like, yeah, we'll get back to them, and we never did. This year, we've been taking advantage of that, and we've been very, very pleasantly surprised by the people that come out there.
Yeah, so discussions about volunteer days. So you've got your subscribers who are saying, I'd love to come out and work on the farm for a day if you need some help. And you've not taken advantage of that in the past, but this year you have, and been surprised at how good of help they are.
Yeah.
Yeah. Yes.
Right, you free up the time, it's like a time, you free up the time for your employees, right? So they can be focusing on the more skilled stuff, and if you use them like a part of the trade, like the farmer we work for, there's a part of the trade for shares, so you get half the value of your share each year if you came every other week, about $3 or $4, whatever it was.
So the comment is about worker shares, and that by offering worker shares, the workers can get their share for half what they'd have to pay otherwise, as long as they commit to coming every other week for a day or something. And then it frees up their hired labor for more skilled work on the farm. So the workers could do the weeding or do easier tasks, and then your paid labor can do more skilled labor. Yeah. Yes?
I'm originally from outside of this particular area of the country, but I'm wondering if you've run across any farms that use like the idea of using like well-compensated labor as part of a value proposition to customers, to help differentiate and maybe justify charging higher prices for produce. But I'm originally from a pretty like wealthy area of the country, where like they're kind of like not realistic farms for like a normal owner operator. So I just don't know how it works here specifically, but like I lived in like the Cambridge, Massachusetts area, and also like in like New York, but like near like Martha Stewart's farm, and like the Dan Carter like close to that's Joan Barnes type institute. So I think it's like a little easier to like charge extremely high prices out there than it is here, but like since so many people here have probably come up into farming through doing like either like undercompensated labor or possibly like exploitative labor, is there any like local interest in like changing that part of this system? And like how does that look to you as a lender
So charging, I missed just a little bit at the beginning of you said you're from an area like the eastern part of the U.S. where there's a lot more wealth, and so you can charge more for CSA shares there?
Yeah, you can charge more for CSA shares, like people will do like partial season shares for like, sometimes like $950 for like 8 weeks.
Oh, okay, so partial season shares or maybe every other week or, yeah.
I will say that I actually had for the first time a couple customers this year who they were scouting our farm, right? So they emailed me or called me asking questions about our farm. And one of their questions was, do we pay our employees a living wage? And that was the first time I had been asked that question. So that was interesting. In our approach to employees on our farm or livestock farm, we hire employees that we want to be able to run machinery and tools and have some experience and skills. So we do actually pay above the living wage to our seasonal employees because we do expect more of them. We expect them to come in with some of these skills already in place, and so that you can rely on them more to, produce a quality work and return week after week. And so that's kind of been our approach. We have very few employees, and we just pay a little bit more to have a little bit more quality work.
So the comment was, you had a question from a customer for the first time this year, are you paying your employees a living wage?
Yeah.
And you said,
People are aware of farm working conditions as it's starting to come out through, different advocacy work.
yeah, so more people are aware that of farm working conditions, and you've always paid a higher wage because you expect more skilled labor and you have maybe a bit more demands on when they show up for work and the types of work that they do. So,
Yeah.
yeah. Okay. Yeah.
I just wonder what the percentage that you would recommend for paying employees. Like a regular kind of business model is what I've read is that no more than 30%. Well, what would be the percentage that you would say for a farm?
Yeah, so the question is about what percentage of the gross revenue should you be paying to your labor? Unfortunately, there's not really a good rule of thumb because every farm enterprise is so different. Some, like a CSA, is going to be really labor intensive. You're going to have a lot of labor. You have other enterprises that maybe, if you're a row crop farmer, you might be able to run 2,000 acres and not hire a single person. So it's a tough rule of thumb to come up with. And as a lender, I'm usually looking at that bottom line. I'm looking at the cash flow, and I want to make sure that there's adequate cash flow there to pay family living, to make the loan payments, to replace stuff that's wearing out, to build up the working capital reserves and all that sort of stuff. So I'm generally not looking that closely at specific line items. Although if the cash flow is tight, I'm going to talk about, is there any place in here that you feel like you can cut? I mean, it's not really up to me to say $51,000 is too much for labor. I'm going to say you can't spend more than $40,000 for labor. It's kind of up to the individual farmer to figure that out. But yeah, trying to pinpoint, it looks like here the issue is with operating expenses, not so much with loan structure or something. Here and then there and then there. If I could.
I was just going to chime in there. Anecdotally, people are saying about 45%, as far as the mixed vegetable operation, if you're about 45% labor, as part of your gross revenues, you're going to be in trouble. So that 30% number is pretty low. So you can go up to very successful farm up in the 40s, but if you get much higher than that, you start to struggle.
Yeah, so the comment is anecdotally about 45% on a mixed vegetable farm is sort of a rule of thumb. You don't want to go above that.
Have you seen like farmers maybe break out things like training costs or like recruiting costs for farm labor? I think they're using a little more model. Maybe like there are farms where employees will return year after year and budget 20% of their own like production on that soil goes up as they get more efficient working like your own. Do you ever like see anyone counting for like those like city costs?
Yeah, so the question is about, do we see people tracking the cost of turnover? That if you have, and then having to train new people all the time. Yeah, I haven't seen anybody really track it to that level. Yeah.
I was just gonna comment on the labor percentage of the cost that I've punished for that number for a long time, and it seems to me like 25 to 30 is pretty good goal, and all that work. 25 to 30 is like we should shoot.
So another 25, 30 sort of range. Okay. So other steps that Rosewater could take, maybe it's more off-farm income, maybe not. Maybe they could sell some underutilized equipment if they've got some underutilized equipment. When cash flow has been extremely tight or negative for an extended period, and so these are sort of some general comments just from working with people on their finances over the last 30 years. Starting with an accurate balance sheet. So really understanding where do we stand right now? What's all the debt? How much of it is due right now or coming due within a year? Keeping a particularly close eye on that working capital position. So what's the dollars of working capital, current assets minus current liability? That's one, if people are in financial trouble or we're in a time where people in general are having some struggles, that's where I'm usually recommending, even if you don't update your balance sheet on a monthly basis, you know, I'm always saying at least annually, but more often if you can, but update the working capital on a monthly basis. You know, really keeping a close handle on that working capital, because that can get out of whack in a hurry when times are tight. Create enterprise budgets based off of the most recent year's numbers, which we just did. Develop a month-by-month cash flow projection, which we just did. Hack away at the biggest expense categories first. Sell surplus feed and underutilized assets. So if you've got machinery, you know, I mentioned the guy with the 17 intermediate term loans. He had way more machinery and equipment than he needed, but he absolutely would not part with any of it. And that's a real problem. Roll some short-term debt down the balance sheet, which is what we did. We took that credit card debt, we rolled it down to intermediate and spread it over 7 years. You don't want to do that a lot because you're taking basically 1 year's losses and now you're spreading them over 7 years. So, it's a more extreme measure. You don't want to just do that lightly. Increase the operating loan if possible and if it's practical. So if they're, you know, they looked out and they said, you know, we're going to end the year, we're going to have a $10,000 deficit. If they could look into the next year and say, well, we're going to make these changes to the operation. We know we're going to gross more, we're going to net more, and we'll be able to pay that operating loan back. That's where I'm saying if it's possible and practical. You don't want to just take it as a Band-Aid. You know, you want to make sure that you're going to be able to pay it back too. Consider FSA direct loan or guarantee. As I mentioned before, like if a commercial lender like us, if we have an FSA guarantee on a loan, we can reduce the interest rate because it takes a lot of the risk out of the loan for us and passes it to FSA. Debt restructure, we kind of did some restructuring with the example here. Principal payment deferral or going interest only. We did some of that at the beginning of COVID. We actually, as a company, COVID hit, and right away we were given a lot more authority to work with our borrowers and do things like principal payment deferrals, interest payment deferrals too, where we could basically just reschedule debt and set loan payments aside and push them to the back end of a loan to ease cash flow. I didn't end up having to do a whole lot of that. I thought I was going to have to do a lot more, but my farmers are so resilient, they switched up their marketing and managed to kind of skate right through. And the federal government came through to some extent too. Private equity infusion might be a possibility in some cases. I've seen it happen where, you know, family comes in and makes a personal loan that's doesn't have payments tied to it and doesn't have any collateral tied to it. Debt set aside, that's not very common right now. It was a lot more common in the 80s where they would actually take debt and set it aside, like essentially take it off the balance sheet, set it off to the side, and then as the farm built strength, they'd start bringing that debt back onto the balance sheet when the farm could handle it. I've got bankruptcy down there, and I put it in really small letters. Bankruptcy is a horrible, horrible option. I mean, I've worked with a lot of people who've gone through bankruptcy. Even with a restructuring, you know, you can go through a Chapter 12 debt restructuring. Most people don't make it out of bankruptcy because you end up being on cash only at that point. If you've already got cash flow issues and all of a sudden every supplier puts you on cash only, you can't get loans anyplace. It's a really, really bad option, but it's an option in extreme circumstances. Boosting off-farm income might be a possibility. Custom work if you have time and you're sure you're going to get paid for it. You don't want to work for someone and then they stiff you. Add a complementary enterprise that doesn't require added debt. Consider temporary scale back or even leasing out land, or a lease or a sale with a leaseback arrangement. I actually just financed one of those. We closed on it last week where someone sold a piece of property and then leased it right back again, but it freed up a lot of cash because they sold it. Liquidate assets, pay off debt if that becomes an option. Hunting leases down by us. A lot of people let people hunt on their land for nothing or in exchange for maybe a day or two of labor, but people are willing to pay for hunting leases. And that's, well, we lease out the hunting rights on my own land and still have the right to hunt ourselves. I'm not a hunter really myself, but my son is. So nice way of bringing in some income, and it doesn't really require you to do anything. What a farmer shouldn't do if you get into trouble: run up credit card debt or rely on credit from either vendors or from online loan sharks. I used to talk about this loan and people couldn't believe that it was true, so I went back and I found the documentation in my file and I blacked out the name of the borrower and the company that made the loan, but this was a guy that he came to me with a loan application for an operating loan, and as I was working on it, he said, I should probably mention that I just took a loan from an online lender. I'll send you the document. So he sent me the loan doc. This loan, it's a $53,500 loan, calculated at the rate of 94% per annum. That's a 94% annual interest rate. 94%. And on top of it, there was an origination fee of $5,350. So he had to pay $5,350 up front. This was a 10-month loan at a 94% annual interest rate. So needless to say, I was not able to make an operating loan to this guy. Yeah, people can't even believe that you could do that, but it's legal. These are commercial loans. There isn't the kind of protections you have with consumer loans. What you also shouldn't do is damage your credit score by failing to make payments. Shouldn't take on additional debt without a good plan to pay it back. Don't ignore your balance sheet and cash flow and just vow to work harder. And that's really, I see a lot of farmers who are in really serious trouble. That's what they do. Just put your head down, just work hard. Ignore the other stuff. If I work harder, it'll all work itself out. Don't make monumental decisions based on a single year's financial performance. We're looking at 1 year's performance for this farm operation. If I was really going to be digging in with them, I'd want to go back, get 3 years of Schedule F, and see if we've got a trend here. Again, with Schedule F, you can kind of play with the numbers, push income back or forward, and do things with depreciation. So you really need multiple years if you're going to do a good analysis. Don't add another enterprise that requires significant capital investment. I sometimes see that happen where they're in trouble and I'll add agritourism. Okay, that's great. Are you going to have to put up a new building? You have to put in a parking lot? Are you going to have to get rezoned? It ends up, there's a whole lot of things that go into it. And it may work, but maybe it won't. Don't move debt down the balance sheet and then forget to pay it off when better times return. So that loan that I showed where we took the credit card debt and wrapped it with all the intermediate term debt, we want to make sure that we don't just say, okay, well, now I've got 7 years to pay it back. If the next year is a good year, chunk it down. Even if it's at a low interest rate, get rid of it. So how do you know when enough is enough? So how do you know that things are so bad that you should exit farming? And that, unfortunately, it does happen. If cash flow is projected to remain negative for more than 2 years, and there's no practical way to bring it positive in the foreseeable future. So you're saying, I'll work full-time off-farm and I'll work full-time on-farm. That's not reasonable. So if equity is eroding in tandem with your cash flow or even at a faster clip. So if you're monitoring your balance sheet and your equity is going down as your cash flow is going down. If the equity is completely gone and unlikely to be rebuilt, that's the time to pull the pin. If farming no longer holds moments of fun or happiness or personal satisfaction, and I've seen that happen too, where it's just not fun anymore. It's hard to get yourself out of bed in the morning, and it just doesn't have the satisfaction that it used to. And finally, if the stress of dealing with the financial situation is threatening your mental health or destroying your family relationships. And again, I've seen it happen a lot. So Longer term, ag is cyclical. Tough times don't last forever, but neither do good times. You know, it goes up, it goes down. So, and hopefully it balances out in the end. I think we need to be thinking more in terms of farm resilience, and that's not just economic resilience, but resilient soils, resilient markets, and resilient communities. And that's what I think is beautiful about this community. That's what we're doing here. You know, we're trying to build resilient communities and systems that build the soil and build healthy relationships. Consumers increasingly are influencing ag production, and I think you guys are all taking advantage of that. You're at the forefront of that. They want to buy authentic organic. They want to buy local. They want to buy from family scale farms. And I think you're all well positioned in that market. So that's what I got for you. Thank you for your attention. I took you a little over, but sorry.